everybody. Welcome back to the Travillian Next podcast. Excited today to dive into the world of depository M&A, which after a little bit of a flurry at the end of last year, we're trying to rebuild pipelines here. Please welcome to the podcast with Josh Nolan, Managing Director from D.A. Davidson, and Jason Hach, Managing Director from Piper Sandler. Guys, thanks for joining us.
Thank you for having us.
I wanted to get started kind of on that flurry of activity we saw in the back half of last year. To me, it was significant for two reasons. One, it was just M&A, right, after a long period of no M&A. But also, we saw a lot of capital coming into the sector and supporting these deals, which, as a former research analyst, is interesting because investors typically aren't super bullish on M&A. So to see them putting capital to work in deals, I thought was really, really significant. So I guess, what do you think? What's your take? Maybe Josh, we'll start with you, and then Jason, get your thoughts. But what do you think were some of the main drivers of that kind of unique environment we were in for 6 months? And I'm sure some of it's still true today, even though stuff has slowed.
I mean, I think that just put a finer point on it, investors were looking for a catalyst, right? The sector had been so unloved and had been underperforming for so long that investors really honed in on this strategy of coming in alongside of management in an M&A trade where you're, buying the stock at a defined discount, where, the management team is buying and marking a balance sheet. You're getting this upside not only in the scale and efficiencies that you would expect in an M&A opportunity, but also the accretion that the management's going to receive now with the interest rate marks that we all came to expect with the rate environment that we were in. So it was a unique opportunity for investors to align themselves with management early on in that process, help really drive those two institutions together because of those balance sheet marks and the need for capital to be raised to really consummate the transaction, and then hopefully realize that upside on the other side of the deal closing.
Yeah, that makes sense. And then, Jason, any thoughts from your perspective, and how have pipelines generally trended? As kind of external activity has come back a little, but are pipelines still pretty robust?
Yeah, so I think a couple of things. I mean, if you go back to that middle of last year and you kind of think about what was happening, right? You had the first presidential election at the end of June, and then you saw a move up in the BKX in the month of July, right? And then you had in July 21st, you had Biden dropping out of the race. So despite your political views, there was a lot of optimism around there's going to be change, right or wrong. There's going to be change, and I think people were clamoring for that. I think when we go back and look at that, we announced the WesBanco Premier deal at the end of July. That was $1 billion transaction, and there was a couple $100 million of capital raised around it. So I think what Josh said. There's a lot of optimism around consolidation. I think consolidation, there's a strong case for consolidation to be made. And that still exists today, despite some of the noise that's going on in the marketplace. When I look at pipelines today, I kind of look at April, this past April. For us, going into the month, we had kind of 5 deals in the pipeline. We've got 4 M&A deals announced in April, right? Including, the Columbia deal with Pac Premier, biggest deal since 2021, $2 billion deal value. But it wasn't just at the high end, right? We had some deals that were $45 million in deal value, and from the West Coast to the East Coast, all the way, from California to Pennsylvania. So I think, it's the pipelines are still there. People want to do stuff. I think you've got some noise now with the trade wars, but I think it is just that it's noise, and I think longer term we're probably at the very early innings of a pretty good consolidation wave here, in my opinion.
Yeah, no, I mean, I think it makes sense, right? I mean, if you're just trying to put your academic hat on for a second and look purely at the performance of the smaller end of the depository group, I mean, that alone would suggest that consolidation is necessary. I mean, profitability is just still not really where it's been historically. But Josh, I'd love to pull you back in, get some thoughts about the pipeline you guys have seen and kind of how it compares to the back half of last year, but also on that size discrepancy, within the pipeline, are you seeing, because there was a supply and demand imbalance, I felt, right, where there were more banks that probably wanted to sell than there were banks to buy them when activity was a bit more robust. Do you still think that's going to be the case?
I think that probably is still the case. I think probably what ends up unlocking that is regulatory relief at the larger end of the size spectrum in terms of, path to deal approvals and allowing the larger institutions to come in and start acquiring again. And I think that's probably the key to not only increasing deal flow, but also unlocking valuations really throughout the bank ecosystem. Because, what we're seeing is the serial acquirer gets to a point where, building scale for the sake of scale stops making sense at some point. When you start approaching 25, 50, 50 plus billion in assets, you kind of slam into this regulatory wall. And so allowing those institutions to continue to create value, to go out and continue to acquire smaller institutions, then, forces the banks further down the market cap spectrum to look at their smaller brethren and really think about building scale in their markets. And so I think that's an important driver. And speaking on pipelines, I think, we saw a wave similar to Trump administration 1.0 immediately following, the elections with the bump in bank valuations. A lot of folks took the opportunity to access the capital markets. Yep. A lot of those raises were done with the use of proceeds being restructuring, some of the losses that were built into the securities portfolio. And then things kind of quieted down as banks began to trade off, and then really became quiet on the heels of the Liberation Day tariff announcements. And I think as we're beginning to get a sense of the go forward operating environment, and some semblance of stability, even though we don't have great clarity into what all these deals are going to look like, things aren't trading plus or minus, 2 to 3% a day. It feels like management teams have reset here and are beginning to entertain, to the extent they were looking to do a deal before, they're now bringing that back to the front burner and saying, this is an environment where we feel like we can get something done again. So we do expect activity to pick back up. And I think that also translates to, the M&A deal activity as well. We just came off of our annual FIG conference here in Scottsdale 2 days ago, and conversations were certainly busy.
Yeah. Well, to me, it's like there's kind of temporary points of friction, right? Like market volatility from tariff uncertainty sucks, but it's temporary points of friction, right? Like theoretically, at some point, it should go away versus like a foundational element that's making things really difficult to consolidate, like huge rate marks like back a year plus ago, right? Or things of that nature that are more structural in nature and could take longer to unwind. Even if the market volatility persists, I do feel like eventually people will just start to get numb. It becomes the normal, right? If the structural components are all there for more consolidation, this should be more temporary than not. Would you guys agree with that?
I definitely agree with that. I think what tends to cause people to pause, and if I'd be rich if I had a nickel for every time I said this, but people tend to get fixated. Sellers tend to get fixated on the price they're getting, right? The aggregate dollars they're getting, and they get less fixated on, hey, I'm going to have 20% of this pro forma company. And when you start to think about, what are you going to be better off, 1 year from now, 3 years from now, 5 years from now, it's pretty easy to make the case that taking 20% of something bigger that's going to be more profitable, that's going to have more efficiencies, et cetera, there's a strong business case for that. The other thing that you mentioned around buyers and like there's a lot less buyers, right? And they're being a lot more selective about the targets. And so they're kind of laying out, hey, this is my ideal candidate. And the question we get asked a lot is, how do I prioritize my target list, right? If, number 10 comes up for sale, but should I go do number 10? Because what do you think about number 1, 2, and 3? So having kind of good information on what people are doing and being able to advise clients on that is a big challenge, because a lot of folks are really, one, being selective, but two, then they're also trying to prioritize their strategic alternatives, because you get even if the regulatory environment as it is, as we're seeing, it's getting better, you're still getting one deal a year. I haven't seen
still like operational constraints, right? Like what can your team handle and what can you integrate? Yeah,
that's right.
And ultimately, you do have to be choosy, right? Because just as a whole industry, I think we got a dose of reality on how good deposits really were, right? And so now you're like, you don't want to be paying up for bad deposits. Like you can just go get those at the margin on your own, right? I mean, like, so it's definitely an interesting dynamic. I'm going to come back to M&A, but I wanted to switch gears for a second and talk more about capital holistically, because I think coming into, I remember seeing the notes, COVID starts, banks are well capitalized, like this won't be like the GFC, right? And then rates go up 500 basis points, and then M&A comes back with capital. And it's like there's this constant push and tug. It's like, well, are we well capitalized? Are we not well capitalized? Josh, maybe let's go back to you. What's your kind of just high level view on capitalization levels in the industry today? Just point blank.
I think from a regulatory perspective, we're well capitalized. But if you look at how we value the industry and what investors focus on, it's compounded tangible book value growth. I think going into March Madness and the failures of Silicon Valley and First Republic, I think we probably were underappreciating tangible book value and the mark-to-market realities there. On the flip side of that, I think the importance is also being highlighted when we're seeing these deals, capital raises being done in conjunction with M&A. I mean, common is still king in the bank space, but I think management teams have also been given these tools, with the sub-debt market really opening up down the market cap spectrum, as well as preferred. We just saw Wintrust get a deal done here this week where there are pockets where you can access capital efficiency, but I still think common is going to be a primary driver here this cycle, especially as we see banks kind of pull away from buying sub-debt near term and deploy that liquidity elsewhere.
Yeah. I mean, that makes sense. And I agree. Like, if you look at regulatory capital, like the ratios are pretty healthy, but it's almost like the M&A deals are kind of indicative of like real-time capital, right? Because you got to mark what you're buying, and then all of a sudden it doesn't look so great. But Jason, maybe pulling you back in, Josh touched on something I wanted to get to anyway, which is, common versus preferred. But would love your thoughts on capitalization and what we learned from that 6 months leading into 2025. And then, where are you guys kind of seeing the interest in your pipeline, common versus preferred? Any thoughts on pros versus cons, or where current pricing is, et cetera?
Yeah, so I think we're talking to clients about, debt, sub-debt, common, preferred, all three. I think if you go back and you look at before the rate moves in 22 started, you go back to 20 and 21, there was $17 billion of debt issued at the regional and community banks. And we were kind of at the epicenter of a lot of that. I think we did 60% of those deals. So most of those deals are coming up to kind of recall dates. So you're seeing a lot of clients evaluate, refinancing opportunity. Do I refinance it? Because a lot of them are resetting to much higher rates. I mean, we were doing deals in the 3s and the 4s, and so you're seeing stuff reset into the 8s. So you're having clients kind of evaluate, do I refinance? Do I just try to pay it off because I do, the banks are pretty well capitalized, and it's a mixed bag. And I think as you get bigger, you get above 10 billion, 20 billion, 30 billion, you get into the larger banks, they're starting to evaluate the preferred and trying to optimize their tier one capital stack. Because when you look at valuations of the top 200 banks, I mean, they're trading at 10 times earnings and 130 a tangible book. So a lot of them are like, well, I really don't want to issue common, but if I can do preferred, and we were involved in that Wintrust deal yesterday. I mean, there's been such a lack of supply. So you go back, and the last preferred deal we were a book manager on was Merchants Bank in Indiana at the end of 24, November of 24. And they come and do a deal, on top of where they could probably raise tier two capital. So there's kind of this unique dynamic in the marketplace right now where some of these banks have the opportunity to get, go and look at preferred tier one instrument, and it's pretty much on top of what they'd pay for a tier two instrument. So it's hard not to kind of put that in the mix. And then when you couple that with, oh, my stock's trading, at 110 or 120 a tangible book, it becomes pretty attractive for some of these banks to look at that. So I think, I think the capital raising stuff's going to be busy. I also do think, when you look at M&A, there's a lot of money on the sidelines waiting to invest in bank stocks, right? I think a lot of these portfolio managers, the last couple of years, we've had down earnings. They've been underweight the banks. But now you listen to them, and there's a bullish undertone with most of them, right? They're looking at, margins are starting to inflect. Credit quality is still pretty benign. Asset growth is, it's going to mirror the economy. It's slowing a little bit, but it's still strong. So you're coming off of 2 down years, and now we're kind of forecasting, double digit earnings growth and revenue growth for this year. So if you're a institutional PM, it's hard to be underweight the banks. It's hard to buy some of these banks, $300 million market cap bank. You can't build a position in the open market. Yeah. So they're really clamoring. I think they want to see some M&A and get, smart M&A, and buyers are being smart. Earnbacks are tight. Accretion's still pretty good. Buyers are being very selective. So I think, the money's there. The investors are ready to support some of these things.
Yeah, I want to come back to that. But first, I want to lightning round through some things with you guys.
Sure.
We'll go Josh and then Jason. We're going to jump through it. Number one, top 2 reasons banks sell today, if you had to try and generalize. It's all right if you guys have the same answers.
Age of management team, and I think exhaustion.
Jason?
Yeah, I think it's different. If you look at, there's 300 banks in the country out of the 4,500 that trade on a major exchange. It's different for those public companies, right? They're looking at shareholder value, and they're having investment banks come in and talk to their boards annually or quarterly. So they're looking at it from a value perspective, and a lot of them realize, hey, we can't generate the returns that the bank 3 or 4 times our size can generate, and we should think about partnering. So a lot for the public banks, it's a little different. For the privately held banks, which is the vast majority of them, it's, you might have a death of a board member, a major shareholder. It's CEOs age out. There's no succession. There's not enough talent coming into the industry. Or the other big thing is they get into a problem that they can't fix on their own, whether it's regulatory or capital constraint. They get some issue that they just can't resolve on their own, and then they seek to find a partner.
Yeah. Okay. Number 2, generally happy with what we've seen from regulatory appointments thus far. Any kind of quick thoughts or contrarian ideas around it? maybe Jason, we'll start with you this time and then go to Josh.
Yeah, I mean, I guess the empirical evidence that I've seen. So, we had a deal, Mid-Southern Bank in Indiana, that we had sold last January of 24, to a credit union. And it kind of sat all year, got kicked out to Washington. Trump administration comes in, and literally within 2 or 3 weeks, it got back to the region and was approved, and we closed that deal recently. So I think I think they want to see consolidation. They want to streamline it. They want to be more transparent and more collaborative with the banks. They're not going to relax. They're not going to unwind stuff that's been done, and they're not going to relax capital constraints and various things. But I do think, from an M&A perspective, it's going to get a little bit easier to get stuff through the pipeline.
Josh?
Yeah, I would echo Jason's thoughts there. I think we've seen some relaxation just in terms of approval timelines, real times and anecdotes from clients in terms of their conversations with regulators seem to indicate that they're going to be more receptive to announced M&A transactions here going forward. But I think we need to see more deals get announced and establish what that new cadence is to understand what the go-forward environment is going to be. I mean, we hit that Liberation Day kind of air pocket pretty quickly before we could really understand the new rules of the road. But it does feel like we've gotten regulatory relief, but the industry hasn't had a great opportunity to test what that actually looks like yet.
Right. I mean, theoretically, that should have been happening now, right? But Mr. Trump had another idea. President Trump, I should say, had other ideas. The last lightning question, and then we're going to wrap it up, is just, if you think back to the last 9 months, as you guys know, our audience here is primarily bank executives. Walk me very quickly through a deal that didn't work out where you think there was something, and you don't have to be specific with names, but something that was like a teachable moment, or something that like you think is worthwhile that people should know. Like, it didn't really have to come out the way it did, or something of that nature. Josh, we'll start with you. I know it's kind of a tough question, but that's why you guys are here.
On the capital market side, we try and be as mindful as possible to not put clients in a position where there's a failed deal, right? You're doing all of that work before you kick off a deal process to ensure that you have good execution on the other side once you go live. The industry has started using confidentially marketed follow-ons for that very reason.
Yep.
For us to be able to give management teams optics into a transaction that meets their parameters before we flip a deal public. And, that is, a great tool to get surety around execution. So, I don't have an example of something necessarily falling apart, but, the one thing I would certainly leave management teams with is, to the extent you are thinking about doing something, it doesn't need to be a binary exercise. You can, get that feedback from the market in a non-committal manner, whether that's non-deal roadshow or using other tools, in order to have comfort when you do decide to actually action an offering. And so we're seeing a lot more of that, and I expect confidentially marketed transactions will continue to be the primary execution method that we use here going forward. So on the capital market side, sorry I don't have any failed deals to give you, but I'm actually pretty
necessarily
happy.
The worst thing, right?
Yeah, I'm happy that that's the case.
Yeah. Jason?
Yeah, I think on the M&A side, look, you have a little bit more flexibility on the M&A side, but I think back to some deals, in the last couple of years, it's been slower on the M&A side, and some of the deals that fell apart the last couple of years, I think the biggest factor was, the sellers didn't have enough conviction in either the currency they were taking, or they felt so that there was so much uncertainty in the market. Like, early last year, a lot of what you heard was, well, we're going into an election year. We don't know what's going to happen. We don't know if taxes are going up and all these things. When you step back, you got to tell clients, look, there's always going to be some level of uncertainty and risk, and it's about how you manage that risk. And really, on the M&A side, it's when you're sitting down with a seller, uh, hey, get to know your buyers. Make your friends before you need them. Get to know your buyers before you're sitting in a boardroom making the decision to sell the company. Do it long before that. And if you do it that way, by the time you make the decision to sell the company, you already know who you're selling it to. And it's a lot more seamless, and it takes a lot of that broken up deals. And look, a lot of deals, there's a lot of conversations that happen until something gets announced. I mean, and deals, every good deal probably fails 2 or 3 times because of market gyrations and uncertainty. So it's really having the conviction to and the fortitude to move forward. And look, that's what we saw in April. I mean, April was the VIX hit over 50. Crazy month, and we announced the largest bank deal since 2021. So I think if management teams have the conviction in the long term, stay the course, and it'll work out.
That makes sense. And then, just to bring us home today, and this has been great, guys. Really appreciate your perspectives and the update. We were chatting kind of in our conversations before this recording about some of the challenges on the IR front for smaller banks, right? It's just not the same environment it was 7 to 10 years ago, right? There's less AUM investing actively in the community bank space today. But Jason, you touched on this a little bit already. You think there's optimism. You think there's money ready to come in. There's just not necessarily like a vehicle or method for them to come in efficiently, right? These things are liquid.
Right.
How can we make this better? Because like a lot of the work I do, like it comes up constantly. It's like, how can we get people more interested in our story? And the backdrop's difficult, right? And you talked about investors wanting to not be underweight banks. I would push back a smidge. The bank group has not been a stellar performer over a 15-year period here, right? I mean, like it's not like a short, like you could dismiss it like, oh, it's 5 years. Like it's a long time. So like what do you think is something tangible we could leave here with in terms of trying to get more investor interest in this small community bank space, which is still doing a lot of important work, still has some banks that have really good deposits. Like how can we try and change this narrative?
Yeah, no, it's a good question, and you're right. If you look at kind of 10 years or 20 years, and you look at the S&P versus the BKX or the KRX, I mean, it's the S&P outperforms by 3 or 4x. I think there might be only one bank or a couple banks that have outperformed, maybe JP Morgan, if you actually pulled the data. What we tell the smaller banks, and look, you can only control what you can control, right? So, it gets back to the end of the basics. You got to grow EPS, you got to grow tangible book value. And for a lot of the smaller banks, even the ones that do that well, they don't always see it reflected in their stock valuation. So they're kind of two different things. I think for money to come into some of these smaller banks, sub kind of $200 million, 250 market cap names, you're going to probably have to see some M&A activity from this group, and they're going to have to look to try to buy the guys that are $400-500 million market. I think it's really hard to play the small space effectively unless you just really have a long-term horizon. Because if you're building book value and you're building earnings, the intrinsic value is growing whether you see it in a stock price or not.
Right. Josh, any thoughts to bring us home?
Yeah, I would echo Jason's point that we need to see more M&A. I go back to my point earlier that unlocking the top of that M&A funnel is a key to the entire sector trading at a higher valuation. Because if the $50 billion bank is buying the $10 billion bank, folks will be racing to get to $10 billion in assets, and that creates demand downstream. So that's one. I think the other thing is that we need to continue to see regulatory relief. regulators have been just chipping away at bank returns on equity for so long that they're now forcing assets out of the regulatory system, right? We're seeing it everywhere. Credit unions, private credit being the probably two clear examples that I can point to today. So I think a continuation there. But going back to a point that Jason made on the previous question, capital is available to smaller institutions, but it does require, the word he used was fortitude. It requires more fortitude to get a smaller cap deal done today. You do have to go out to maybe more parties than you would have had to go out to previously. And it may not be raised at exactly the price that you want it, but capital is available. And I think that is an important message. And we're also seeing a rotation in the space from maybe some of the legacy capital providers to some new up and coming funds and investors that maybe aren't quite, a household name or aren't associated with the bank mafia, which is a term we all know and love. So, I think we're seeing an evolution of that ecosystem real time. And I think as the opportunity avails itself, capital formation will happen.
Yeah, I think you guys would share the sentiment. I mean, the longer you're in this racket, the more you realize the markets aren't as efficient as most people think they are, right? So I think we would all agree, stay patient, keep building your intrinsic value, make sure you're evaluating your strategic alternatives effectively, and with any luck, the environment should hopefully pick up and be a bit more favorable.
Agree.
Yeah. Well, thank you guys so much for joining. Sounds like I got you just at the right time before things get busy. Fingers crossed. So appreciate all your insights and thanks for hopping on.
Thank you. Thanks for hosting.
Mike.